Let's talk about your biggest thing that you can do right now today to increase your cash flow. It's this: think like the bank. Now, if you had to say, what does the bank do versus what do, you would realize that there are two completely different set of playbooks that each operate by. It's almost like we are doing the exact opposite. Let me show you how. The bank focuses on getting as much money as possible, as often as possible, holding it as long as possible, giving back as little as possible, and taking as little risk as possible. Now, if that sounds completely opposite of what you've been told to do all your life, that's because it frankly is. We've been told to put away as much money as possible, as long as possible, leave it there, don't touch it, take out as little as possible, and take as much risk as possible. So what's happening is we have our own personal economy, and we need to recognize that there is an economy or financial statements of the other entities that we pay, and they're opposite. So when we pay to the bank, whether it's paying off a loan or putting money into a retirement vehicle or putting money into stocks or mutual funds, we're putting money into their pocket, and that's their income. It's our expense. So it flows from our economy to theirs. And what happens during that transfer is now they have control of those dollars, and they're able to use them within their economy to grow and prosper. So let's find out exactly what the bank is doing and the 7 rules they operate by, and how you can model that behavior so you're not relegated to just being a customer of the bank that builds up the empire of the banking system. Rule number 1, banks want cash flow. They want as much money coming in as possible, which means they want money repaying loans as quickly as possible. They want money coming into deposits, but primarily they want loans being paid back. Banks also want to have you putting money into retirement funds or capital with their institution. The more cash flow they get, the more they can do with that. Rule number 2, banks earn interest. They use arbitrage to have a lower cost than what they earn on the same dollar. If they receive a deposit and they pay you 1% on that deposit, think of a $1 deposit. If they pay you 1% interest, they're going to pay you 1 penny. If they can turn out and loan out that $1 at 5% interest, they will charge 5%. The difference is the spread of the 5% minus the 1%, what they earn versus what they paid on the same dollar. That is 4% spread. But when you look at it in terms of the volume, it's actually a 400% rate of return. They have earned 400 times as much because their cost was 1 cent and their payment or their earnings were 5 cents. So when we look at that spread, we realize that we can employ that in our own life as well. How can we have a cost of capital lower than what we earn on that capital? Rule number 3, banks use leverage. They're able to take a small amount of money and turn it into something larger. Their ability to do this is magnified by the fractional reserve banking system, which means that they need to hold $1 in reserves for $10 that they loan out. Here's how it works. You put in $1, they're able to loan out $10 more, at interest again, mind you. So they're using your $1 as leverage and creating $10 more with that. And then when those $10 are repaid, they're able to create $100 from that. That leverage is what allows them to have more velocity of money and create more cash flow. We can use leverage the same way by finding out how we can use loans or liabilities to create more money. Rule number 4, banks use OPM, other people's money. They don't only operate on their own capital. In fact, they didn't even start with any capital to begin with. The capital they started with was money that they received from depositors or from the Federal Reserve. When they have that money from other people, they're able to take that and create more with it. You likewise can do the same thing. You can use other people's money, investors, or taking loans, and use capital from other institutions to create leverage, interest, and cash flow. Rule number 5, banks want money back faster. Think of this. Usually, as the consumer, we use interest rates to make decisions for what we feel is in our favor. One loan might be 4%, another is 3%. We feel that a 3% loan is better for us to take because we'll pay less interest. That's only part of the story. If instead we realize that interest rates are set by the banking system to incentivize us to do what is best for them, we can see this differently. Looking at a loan the bank extends, if they lower the interest rate, it's because that loan is more advantageous to the bank. Think of it this way. A 30-year loan is more likely to have a higher rate of interest, and a 15-year loan is going to have a lower interest rate, or APR. What that means is that we can look at that and say, well, I'm going to save money if I take the shorter 15-year loan. However, in the bank's mind, they love the 15-year loan because more dollars flow back into their control more quickly. They don't have to wait 30 years with small payments. They get larger payments over a shorter period of time. They get the cash flow back quicker. Think of it in terms of deposits. A 15-year CD is going to pay a higher rate of return for somebody putting their money with the bank than a 5-year CD or a 3-month CD. The reason? The bank has control of that capital longer. So again, the bank wants to get their cash back more quickly, and we can use interest rates to figure out what's most advantageous to them. How can we apply this in our own life? We want to figure out, how do we get more cash back into our control as quickly as possible? Instead of thinking how quickly we can spend or consume, let's think about how quickly we can pay ourselves back so that we have more capital flowing into our control as quickly as possible. Not out of our control, but into our control. Number 6, banks take guarantees. Now, the banking system and financial institutions take the guaranteed management fees on your money. When you put your money into a mutual fund or some type of retirement plan, they're going to earn whatever their fee amount is. Say it's 1% or 2%. That's going to be a guaranteed fixed income for them that is going to always be positive. Now, you, on the other hand, might ride the ups and downs of the market. You may have months or years of wins and months or years of losses. Now, you're taking all the risk, and they're getting the guaranteed, consistent rate of return. So how can we change our perspective and our philosophy? We don't want to take as much risk. We want to take less risk. Less risk with guarantees is more valuable to you in the long run because you know you're not at risk of losing money. So think about how you can get guarantees, not possibility of wins and losses. Number 7, banks want low risk. Now, from being in the shoes of the customer of the bank, imagine trying to get a loan if you had no income and no capital. They're going to say, you're a risk to me. I'm not going to give you a loan, or I'm going to charge you a very high interest rate because you are a risk, right? So when you do have the capital and the cash flow to repay that loan, you're not as high of a risk, and the bank is more likely to lend to you. How you want to apply this in your own financial life is you want to say, how can I make sure that I invest in things that are low risk, that I have a guarantee to be repaid, as opposed to a high risk for my capital? If you're looking for an investment, make sure you're in a position where you recognize the amount of risk you're taking with that capital and look for the guarantee to be repaid. So as we look at what the bank is doing and what we're doing, it gives us this opportunity to open our eyes and recognize the more often we get money flowing into our control by paying ourselves first or having cash flowing assets that pay us, the more cash that's coming into our control, the longer we hold on to that capital, the more we put it to work for us, the less we give out of our control, and the less risk we take. We are now in a position to keep in control more of our capital, increase our cash flow, and profit financially in the long run, creating true financial freedom. Hey, thanks for watching. I really hope you liked this video. If you did, click the link in the description box below for more information. Like this video, share your comments, questions, and feedback in the comments section, and don't forget to hit subscribe to our YouTube channel.